Hey guys, welcome to another Trade Genius podcast. Bob and Phil here as always. Guys, CPI came in hot. That means inflation is sticky. Markets did not like it. We're going to talk about what happened today and what we can expect going forward. Let's dive in.
Trade Genius.
Hey everybody, it's Bob with Trade Genius. Hey, it is holiday season and our holiday specials are running right now. Use promo code HOLIDAY. You already blew it. You missed the Black Friday specials, but this is your second chance to take advantage of some of the best pricing that we do for the year. Check us out, tradelikeagenius.com, tradegenius.co, tradegeniusacademy.com. All roads lead to Trade Genius. Check us out. Incredible deals. Thanks for listening.
So, Bob, the last couple of CPI prints have been pretty much in line with expectations, and there's been victory laps by the Fed and by Yellen about how they're getting inflation under control. And then, lo and behold, today we had a number that wasn't slightly hot. It was quite a bit hot, and the markets did not like it. What do you think?
Yeah, and also, they never really got it under control.
Yeah.
They might have met expectations, but they could not break this thing down below 3.8%.
Mm-hmm.
And now we're accelerating again. And really interesting how seasonals work. We had a gap down when the middle of January, seasonal was supposed to go weak. They bought it back. We had a gap down at the end of January. They thought they bought it back. And now we have another gap down, which is a huge gap down, biggest one I can find in 2 years, in the mid-market season area for weakness. And if they don't buy this thing back, then I think we can see weakness to the at least the end of March, or maybe even to the middle of March. And we're going to show some of the components here in a second, is that the things that are not in control, they can't control. Because I think the issue we have here is the demographics around employment and skills. The areas which are going up in price, they can't dictate. Like, they can't just kill the oil market or kill this market, because these things are outside of their control. Right. And we should probably throw some charts up here to show people what we're talking about. Yeah, and this one here this is amazing. And we fell all day, Phil. We're talking right at the close here. A slight short covering rally here into the close. But if we get follow through, this is a gap down in the middle of OPEX week is probably not what they wanted to see, I don't think. What do you think?
Yeah, I mean, obviously, this chart here is telling us worse. You can see this is all of the CPI reactions that we've seen, and more or less they've been, nothing to write home about. But this one's definitely one of the biggest drawdowns that we've seen since 2022. And why is that? Well, it means that it's higher for longer, right? Now, we were talking about how the Fed funds futures market had been pricing 3 to 6 cuts in for this year. Bob and I were both scratching our heads because, unless somebody knew something about this economy falling off a cliff that would force such a reaction, really there wasn't anything there fundamentally yet to support that. And even if you are a believer in the recession coming later this year, as we are, you're probably only looking at 3 cuts into the end of the year unless things really started to accelerate down. So I think this finally smacked the markets right upside the head, because there was everything that was being priced in was predicated on that core CPI, which is basically cost of living stuff. And really what the Fed focuses on is that ex housing CPI. So if you look at the numbers here, right? So while inflation's at 3.1%, if you look at the basic stuff that we need, car insurance, transportation, hospital, medical, car repairs, stuff like that, homeowners inflation, all that stuff is just smoking red hot still. And so both core CPI and headline CPI coming in hotter here. And this is exactly what the Fed, and I think the problem here is that I think Jerome got called into the principal's office. And so he had to come out, not this last meeting, but the meeting before, and he got, sounded really dovish about, oh yeah, we got to start looking at cuts, and you and I discussed that about, well, does he know something we don't? Is the recession coming in hot and heavy? Otherwise, the reaction by the market was just, they were overjoyed to hear him be dovish. Then they kind of strangely walked that back immediately. So I think he had to say something to appease his masters, being the administration, and all this stuff about them being, apolitical is kind of funny, because, at the end of the day, the administration is always going to lean on them to get whatever they want done. But that being said, the market rejoiced, and then they had to walk it back. And this is why they had to walk it back, because if this market continues to do what it's doing, all of this stuff reignites. nights, and then we are higher for longer. So I think that's why the market had the reaction it had today, because they were really banking on the CPI prints coming in line. Even if they were in line, met expectations, this market would not have reacted the way it did today. So they came in way hotter. And, so now it's like, okay, so if it is higher for longer, what are we going to expect? And I think you should expect higher for longer, right, Bob? Because look at this next chart. Core services X housing, which is really the one that matters, is really starting to ratchet back up here. And that's going to be a big problem. And the market's going to have to contend with that going forward.
And this is the one that the Fed looks at the most. I think there's a core services subset that's over 10%. And what's really interesting to me is that I was talking to a couple business owners that I know pretty well, and they're sharing with me the basically inflation from 2021 to today is 40% increase overall inflation. So they laugh when, we talk about this stuff all the time. They laugh when they say 2%, 3% inflation. They say, is that per month? Because some of the stuff that they got hit with, rent and food supplies and employment costs and healthcare costs, they said we're up 40% over 3 years. So you're looking at a 13% inflation rate. That's true. And that's kind of what it feels like to me personally when I look at our budget, because I do all the bill paying and the juggling that we have to do and the things that we don't do because of basically our costs have gone up 30%, and I have a fixed mortgage.
Yeah.
So it's crazy. And healthcare blew out on us too. That's the thing about it. When they said healthcare remember that was a good guy the last 2 months, negative 30% down. Mm-hmm. And I'm double digit every year on my healthcare expenses. So guys, this is going to be a big issue. When March comes around and he's not talking about cutting till July, Phil, that's the last time they really can cut, because they like to do nothing during the political season, leading up to the election. So unless something happens that makes them start doing cuts in June and July, that we may go back to your scenario. Remember, you said you didn't think they'd do any cuts until 2025, and then they're going to bomb this market down.
Yeah. So I think it really comes down to typically we're in the pausing stage of the cycle, and typically what follows that is the cuts, and that typically coincides with market and economic deterioration. So for me, I think the next few prints after May, so the data that comes in June, July, August, I think is going to be very, very important, and I think is going to essentially dictate what the Fed does in terms of cuts at that point. But as far as what the market's going to do here, we're in OPEX week. We talk about how you typically get a high on Tuesday or Wednesday. More rarely you'll get one on Monday. That may be the case here. I think we have to claw back over. I think on the futures, you're going to want to see basically a move back over 49.65, and maybe that potentially can get a squeeze going back higher. Bitcoin kind of dusted itself off and did a lot better in terms of bouncing after the negative reaction. I think that's more about the ETF flows right now. They're pretty heavy, and I think that's going to be bullish for price in terms of the short term. But in terms of like what happens, I think OPEX, we still have tailwinds, but essentially Friday morning, all of that evaporates when we do have our OPEX. And then next week, I think, we're going into not only that hangover from OPEX where you have that window, but we also have a seasonally very bearish period now between basically the middle of February into the first and second week of March. And, now with this reaction here, I think we have a good concoction here where we have a decent pullback that fulfills that seasonality into March. Now, how far and deep we go, that's to be determined. But if we don't have too much technical damage in the market where the hedging flows are then basically selling begets selling type of scenario, this market will dust itself off. And I think you have to be careful about an upside squeeze to challenge the highs. So if we just put in the local highs, then we got to watch out for that potential squeeze that could last, because seasonally that runs up into May, June. But after that, Bob, I think that's where we got to be very careful. If you do get that final pop off, that this market goes into bear mode from there into the end of the year. I think that's where you got to be really, really careful with your portfolio.
Yeah, look, energy's up. So this is the trade I've been looking for. Energy up, tech down. And if that takes hold, there's no way inflation expectations are going to lower themselves. And we could be looking at, 10% plus move on average during these next 2 months on oil. I think it'll probably be more than that. Because remember, when interest rates go up, oil tends to go with it, and it becomes a self-fulfilling prophecy. And that's going to keep keep the Fed from being able to pause. And so in that scenario comes, I'm looking for a lower high and deeper damage, but it feels right with what he said here. We have this is just another pit stop on the way to an ultimate high. Then the fall is going to be pretty brutal. Remember, March killed the 2000 market. Okay, and we went into a 2-year bear market. So, and I think in 2008, I think the June or July killed the top too. And then we went into a multi-year bear market. So we're close, guys. You know, you can't convince me otherwise. Economy is suffering, prices are high, and economic activity is faltering. And that's just a recipe for disaster.
Yep, agreed. Let us know your thoughts below, guys, on the stuff we covered here and how is inflation affecting your bottom line. Love to hear your thoughts. Otherwise, guys, thanks for watching. Please hit like and subscribe, and we'll see you on tomorrow's video. Take care.
Trade Genius.